The market that you need to go to, the asset classes that you need to go to increase the durability of your portfolio, the risk mitigation characteristics that typically you might get from treasuries, some people are questioning. The risk mitigation characteristics that you might get from a sector like utilities, some people have been questioning. In fact, many people have through this drawdown over the last month or so. You wrote a note yesterday on utilities. Your views right now?
Yeah, I think, one thing on utilities that was really interesting is that they played absolutely horrible defense coming into the volatility. In fact, technology, healthcare, super staples all outperformed massively. In fact, utilities were almost as bad as the market coming into that. That's not the role that they played during prior volatility events. For example, in 2008, during that volatility, utilities played very good defense, and they were down but outperformed the market. I think today, right now, it's not a question so much about fundamentals as coming into the volatility as it is about the valuation was really just way overextended in January and February. Today, the valuation is much more stable, and I think there's always bull and bear arguments you can make about how utilities are going to fare into this sort of post-corona economy. But I would venture to say that those cash flows are relatively, or certainly on a relative basis, are going to be about the most stable you're going to find. And with the valuation reset in utilities, I still think that they will continue to trade reasonably well, even if the broader market is lower. And I think there's sort of a echo of, we saw this bid for investment grade paper after those frantic lows. I think there's sort of a variation of that theme going to play out with utilities. I'm not massively bullish on them, but I think could they be up another 15-20% here against a range-bound equity market? I think the answer is going to be yes.